Hello, everybody. What's that? Okay, let's see. Alrighty, so this is where we left off yesterday. Financing small businesses and entrepreneur ecosystems using LIC.org. And so far, this business is like the largest business that does grants and loans for nonprofit and for-profit businesses that I've found. And for me, it seems like, hola, Mar. Ajá. Amor, estoy haciendo vivo ahora. Dame 30 minutos, por favor. Ok, gracias. Okay, so this is financing small businesses on entrepreneur ecosystems. We looked at the supplier capital yesterday. That one is pretty tough to get. The business has to be at least $1 million, and with the goal of getting to 5 million, and they will give you $250,000 to $500,000 with this program if you qualify to invest in things that will help you get government contracts like compliance, like hiring staff. You can't use for payroll, but you can invest it in certain things that can help you get procurement and government contracts. So today, what I'm going to look at is the commercial and real estate loans and see how that works. So it says we offer a suite of affordable commercial and real estate loans to provide business working capital, money to make leasehold improvements, and capital for developing community and enhancing maker spaces and commercial projects. So let's go there. LICS works with you to understand your organization and your project vision first. From there, we collaborate with you to identify a loan product that sets your project up for success. Pre development, early stage investment in planning, design, and environmental and structural assessments for projects that are proceeding to construction. Proceeds are used to pay due diligence expenses, deposits, and other developers' costs. Loan amount is 50,000 to $2 million. Interest rate starts at 7.85. Term is up to 3 years. Repayment interest only, payable monthly. Loan fee up to 1.5% of loans amount plus legal fees. Collateral flexible. Collateral required for loan above $500,000. Acquisition financing to help pay the purchase price and closing costs for the property acquisition. These loans are generally made when construction and permanent financing have been secured or preliminarily committed. Loan amount is 100,000 to 10 million. Interest rate 7.5, term up to 3 years, interest only, payable monthly. Loan fee is 1.5% of the loan amount plus legal fees. Collateral, real estate collateral with LTV up to 85%. Let's see what some of the stuff means. Get chat. Can you tell me? I'm looking at a loan. It says the loan amount is 100,000 to 10 million, but it says loan fees up to 1.5% of loan amount plus legal fees. Can you explain to me what that means? And can you explain to me what collateral, real estate collateral with LTV up to 85%, and what does that means? These are very common terms in large business or real estate loans. So let's break them down simply. Loan fees up to 1.5% of loan fees plus legal fees. So the loan fee, if it's $100,000, then the loan fee will be 1,500. A million will be $15,000 loan fee. So if you borrow $500,000, the lender may charge you up to $7,500 just for setting up the loan. This is usually called origination fee, loans fee, arrangement fee. Legal fees. On top of that, you may also pay attorney drafting fees, document preparations, title search, record fees. Example, la, 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 la. So $500,000 origination fee of 1%, 7,500. Legal fee could be $2,000, so total of 9,500. And sometimes that's deducted from the loan before you receive the money. So instead of receiving the $500,000, you probably receive around $490,000. Real estate collateral. This means you must pledge property as security for the loan. Example of collateral: house, apartment buildings, commercial buildings, lands, rental. If the borrower doesn't repay, the lender can take the property through foreclosure. LTV, loan to value up to 80%. LTV means how much they will lend compared to the value of the property. LTV equals loan amount divided by property value. Example one, property is $1 million. 85% LTV means they will end up lending you $850,000. You would need $150,000 equity. Okay. While lenders use LTV, it protects them. If you default, they can sell the property and recover their money. Example: property is worth 100,000. Property is worth $1 million. Loan is 850. If the property values drops, they can still recover most of the loan. How this usually applies to business loans. Not important. One important warning: if the lender says up to 1.5 loan fee, that's usually very reasonable, but be cautious if you see 3 to 5 upfront fees, large application fees before approval. Sometimes lenders charge very high brokerage fees. All right. So they have a pre-development option for up to $2 million, acquisition option up to $10 million, construction option, loans to projects either as a sole source of financing or in concert with other lenders. Construction loans are developed for hard and soft buildings and development costs, including new constructions, substantial or moderate renovations, and leaseholders improvement. Loan amount 100,000 to 10 million, 7.35 interest rate. Term is 3 years. Interest payable. Loan fees up to 1.5 plus legal fees. Real estate with LTV loan to value up to 85%. Mini permanent. Long term, partially amort- amortizing loan for certain projects, including rental houses, housing, community facilities, and economic development projects. LIC mini permanent loan is typically originated as a construction loan that converts to a mini perm, which certain conditions are met, such as issuance of certificate of occupation and or stabilized operation. What is a mini permanent? What is a mini permanent? When it comes to real estate loans. A mini permanent, often called mini perm, is a short term real estate loan that acts like a temporary permanent loan after construction or renovation is finished. It basically bridges the gap between a construction loan and a long term mortgage. The simple way to put it, there are usually three phases in real estate development: construction loans used to build a property, mini permanent loan, mini perm, used after construction while the property stabilizes, permanent loans, long term mortgage, 30 to 20 to 30 years. The mini perm is the middle stage. Example: imagine someone builds an apartment. Step one, construction. The loan, $5 million construction loan, terms 12 to 24 months, used to build a building. Mini perm, after construction finishes, the building may not yet be fully rented, so lenders may give a mini perm a loan of 5 million, term 3 to 7 years. This gives the owner time to lease the apartment, stabilize income, increase property value. Permanent loan, once the building is stable and producing income, the owner refinances into a long-term loan, example, a 30-year commercial loan. Why mini perm loans exist? Banks don't like giving long-term mortgages on unstable properties. A mini perm gives time to lease up the building, increase income, improve property values, show stable cash flow. All right, cool. Let me write that down. Mini perm construction LTV loan to value. Loan fees can be high. Another thing I want to, amortizing loans. What does that mean? What does amortizing loans means? An amortizing loan means the loan is paid down gradually over time with regular payment. Each payment includes both interest and principal. So every payment, part of the payment goes to interest, part goes to reducing the loan's balance. Over time, the loan balance slowly goes down until it reaches zero at the end of the loan term. I mean, that they use this fancy word for a regular loan payment. Example, $100,000, 6%, 30 years, payment $600 a month. Okay, it says month one, the interest could be $500 with a principal $900, $99. And then month 50, the interest could be 470 while the principal is 129. And then month 200, the interest is 250 while the principal is 349. So it looks like it starts with a higher interest in these type of cases. And then as time goes down, the lower the interest and increase the principal pay amount that's being paid. So notice something important. Early payments is mostly interest, later payments is mostly principal. See where using amortizing loans. Amortization is used for most loans like home mortgages, auto loans, commercial real estate loans, some businesses. For example, $40,000 car, 5-year loan. Every payment slowly reduces the loan until it's fully paid off. Amortizing versus non-amortizing loans. The loan is completely paid off by the end of the term. 30-year mortgage, blah, 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 partially reduce the loan. Partial. Okay, just give them. I don't know. It's really not saying a bunch of anything that's spectacular. And he's in. Let's continue. Permanent, long-term financing or refinancing of acquisitions, construction, and renovation projects in low-income areas or that serve low-income populations for several project types, including rental housing, charter schools, health centers, and commercial and nonprofit assets. Loan amount $500,000 to $10 million, 7.35, typically up to 15 years, longer on exception basis. Fully amortizing payments payable monthly. Loan up to 1.5 plus legal fees. Collateral, first lien on real estate collateral with loan to value of up to 85%. Additional collateral required for any amount in excess of 80% of the loan to value. Bridge financing to bridge the time gap between expenses needing current payment and receipt of cash from committed and anticipated sources of capital not yet available, including capital, campaign commitments, public contracts, or note proceeds, earned developers fees, and tax credit capital contribution. Loan is 100,000 to 1 million, 7.35, 3 interest only, payable monthly. Okay, let me see something. Okay, let's say there's $1 million loan and it's asking, and the repayment says interest only, payable monthly. And then there's another loan that says repayment fully amortizing payments payable monthly. What is the difference between the two? Is it that on the interest only, you're only paying the interest and it never really goes down to zero? Can you please explain this, please? Yes, you're very close to understanding it. The difference is exactly about whether the principal, the loan balance is going down or not. Let's use your example, $1 million loan example, interest only. With an interest only loan, your monthly payment only covers the interest, not the principal, so the loan balance never decreases. Example, $1 million loan, interest rate 6%, yearly interest 60,000, monthly payment is 5,000. So you pay $5,000 per month, but after 1 year, your loan balance is still $1 million. After 5 years, the loan balance is still $1 million. You have not paid down the loan at all. What happens at the end? Usually there's a balloon payment. Example, loan term is 5 years. You pay $5,000 for the 60 months. At the end, you must pay the $1 million or refinance the loan. Why investors like interest only loans? Because monthly payment is lower. Example, interest only loans $5,000 a month. Amortizing loans could be $6,000 a month. The lower payment equals more cash flow. Fully amortizing loans. A fully amortizing loans mean each payment includes interest and principal, so the loans slowly goes down each month. Example, $1 million loan with 6% interest, term is 30 years. The loan is roughly $6,000. Each payment reduces the balance. Example, month one, $5,000 in interest, $1,000 in principal. Month 12, $5,000 with $4,950 in interest, $1,050 in principal. Month 120, $4,300 in interest, principal $1,693. After 30 years, the balance goes to zero. The loan is completely paid off. Okay, so interest only versus amortizing. Okay, I mean that's interesting because at first I was like, why would anyone want interest only loans? But it makes some sense. Financing to fill credit gaps for our strongest borrowers by providing flexible working capital lines of credit to meet organizational cash flow needs or pay project-based expenses. 100,000 to 3 million, 7.8% interest rate, working capital, LOC, up to 2 years, project-based, LOC, up to 3 years, LOC. What am I missing there? Loan fees 1.5, flexible, generally secured. All right, so if we're looking at a line of credit for a business and it says terms is working capital LOC up to 2 years, project based LOC up to 3 years. What does that mean exactly? LOC is LOC line of credit. Working capital LOC, working capital line of credit up to 2 years, project based LOC up to 3 years. I'm pretty sure LOC stands for line of credit. LLC does mean line of credit. A business line of credit works like a credit card for business rather than a traditional loan. Instead of receiving all the money at once, you can draw money when you need it up to the credit limit. Working capital LLC up to 2 years. Working capital means money used to run the day-to-day operations of the business. Example, payroll, marketing, inventory, rent, equipment, short-term expenses. So when it says working capital LLC up to 2 years, it means you can borrow funds from the credit line. The line of credit lasts up to 2 years. During that time, you can draw and repay repeatedly. Example, line of credit limit 200,000 over 2 years. You might borrow 50K, then repay it, borrow 80K, then repay it, borrow 30K, then you repay it, and you can reuse it until 2 year terms end. Project-based LLC up to 3 years. This type of LLC is meant for specific projects, not general business use. Example, real estate renovations, construction projects, business expansion, large contract fulfillment, manufacturer order. Example, a construction company wins a $2 million contract. They need money for material, labor, equipment. The lenders give a project-based line of credit. Example, $1 million. The company draws money from the project's progress. Phase, starter material 200,000, labor 150,000, equipment 100,000. Then when the project is paid, they repay the line of credit up to 3 years. Okay. All interests are subject to change based on underwriting approval. Lower rates are available based on available funding sources, size, and terms of the loan apply. Loan product overview. Yeah. Just pretty much a document showing everything that we just went over. So, from what I've discovered from LLC, is that they really only have one grant. Well, in Atlanta is 100. I'll probably look at a different state that they might be in. I think they have multiple locations. Last time I checked, I think it's about 20. Maybe they have different grants in different states, hopefully. But now my conclusion with this program is it only has one grant right now in Atlanta, and then it manages some of the other grants for different programs. Yep. So that's about it. Hi, Miss Lena. I'll see you guys again tomorrow at 8:30. If you have any questions, right now is a good time because I'm about to close this thing up. Thank you.